Today's webinar. I'm Taylor Summer, Marketing Manager here at Minoan. I'm thrilled to be your host for today's session. For anyone who is new to Minoan, we're a free centralized ordering platform that allows hosts, property managers, designers, and boutique hotels to furnish and replenish and create a digital showroom in their space. Now it's time to introduce today's special guest, Ryan Bakey. He's CPA and the CEO of Tax Strategy 365. Ryan has helped thousands of real estate investors boost their take-home earnings and become tax savvy by leveraging the tax code effectively. Now he's ready to share his insights with us. Just a few housekeeping items before we dive into the good stuff. The chat is open if you simply want to react to any takeaways. And Ryan has also brought his colleagues, Mason and Kevin, here to help answer any quick questions in the chat. But we will be having a Q&A at the conclusion of their presentation, so feel free to put any burning questions into the chat, and we'll try to address as many of those as possible at the very end. Everyone is muted by default. Please remain muted throughout the presentation. So let's get started. Ryan, thank you so much for joining us today. We're really excited to have you here. I'm going to go ahead and turn it over to you so you can tell our audience a bit about yourself and all the incredible work you're doing.
Awesome. Thank you so much, Taylor. Welcome, everyone. Good to see everybody today. Thanks for taking time out of your busy schedule to be with us. My name is Ryan. I'm the founder of Tax Strategy 365 and RE Tax Prep. So we have two companies. We help real estate investors file their tax returns accurately, efficiently, and effectively, as well as we help people strategize on how to actually save money on taxes, which are we're going to learn a little bit about today. Those are two different skill sets. So there's the actual filing of your tax return, but then there's the art of making sure that you know exactly how much money you're going to owe or get back and what are some of the strategies you can do to implement and save money on taxes. I have with me Mason, Kevin, and Elizabeth. They're from my team. So if you ask a question in the chat, they'll be able to answer your question just like I would. So, okay. Who's excited to talk about taxes? Okay, I didn't think so. All right. Well, I'll make it pretty exciting. I hope so anyway. So today's my promise today, we're going to learn the tax strategies that you need to know. We're going to talk about the biggest tax mistakes that rookie investors make. So these are a lot of deduction mistakes, a lot of entity structuring mistakes, and we're going to talk about how you should structure your short-term rentals from a liability perspective in order to save money on taxes. A little bit more information about me. I worked at Deloitte, which is a consulting company. And before that, I had a couple of various like odd jobs. My first ever legal job was I was pushing grocery carts at Meijer for $7.25 an hour in cold Chicago winters, and it taught me a lot of lessons about grit. I also worked a job at a Lou Malnati's. It's a really good pizza place in Chicago, and if you're from New York, I promise that we have better pizza than you do because I've been there and I tried it. So I could say Chicago pizza is better. One of the things I learned at Lou Malnati's was we had a pizza chef, cook, if you want to call him, cook or chef. And he was there. He was working at the company for 23 years, never left. And I asked him, I was like, hey, what goes into making the best pizza? Like, is it the sauce? Is it the toppings? Is it the dough? And he's like, Ryan, well, you can be the best chef in the world, but if you have rotten ingredients, it ain't gonna work. But he says the best chef in the world knows which ingredients are rotten and which ones are not. And I see a lot of similarities with real estate investing because it's all about numbers. I mean, a lot of people want to tell a story about why a property in a certain area will perform better than others. But at the end of the day, math works in all 50 states, except maybe California. Not to pick on Californians, but math works in all 50 states. And so the skills that you need to be a real estate investor and to be a successful real estate investor, you learn all those by the fourth grade. It's just addition, subtraction, multiplication, and division. So you can't make a good pizza without great ingredients, but the best chef knows which ingredients are rotten, right? And so that's where I would, advise a lot of you to get your templates, calculators, helpful resources, know your budget, like know how much you're going to spend on furniture, rehabs, things like that before you go into a project. So while I worked at Deloitte, it was a big consulting company. I realized that I was helping people who are already rich and wealthy get even more rich and wealthy. And I decided that I didn't want to help every person in the world because honestly, I think not everyone in the world is called to build a tremendous amount of wealth, but there's normally one person in a family that's going to change their family tree, and that's who I set out to help. So I left Deloitte, started a company focusing on tax strategies for real estate investors primarily, and kind of grew that ever since. This is a picture of my first duplex. I lived in the bottom of this and I rented out the top, and you can see the ugly stairs going up to it. But this is actually probably the best investment I ever made, not because of how much money it makes. It cash flows about $1,000 a month now as a duplex, which is great. But it taught me a lot of lessons about being a real estate investor that I would have never known if I actually did the thing. There's so many books you can read, websites, podcasts, but you'll learn more. We used to say this in business school all the time, but you'll learn more about business after 6 months of running your own business than you ever would with a 4-year business degree, and I truly believe that. So you're going to learn the most once you get into the property and get your hands dirty. But it taught me a lot. $10 versus $50. I throw this up there and you're like, what the hell is it? Well, there's a psychological study that shows if you lose $10 out of your pocket, that you have to find $50 in order for it to make up for it. Okay. I know it sounds weird when most of us are math people, $50 greater than $10. But there's a psychological effect of when you actually lose money. Okay, whether it actually falls out of your pocket, or you have to pay a penalty or a fee, or maybe it's a late penalty from the IRS. But there's a psychological effect of when you lose money that you actually have to make more money to make up for it. And when I was at Deloitte, one of the things a lot of people know that when you work in corporate America, they give you sort of like corporate handcuffs. So they give you raises, bonuses, they try to get you to stay longer, they try to get you to work harder and get that next raise and bonus. One of the things when you pass the CPA exam is you get a $5,000 bonus with your next check. So I got my regular paycheck and I got a $5,000 bonus. Now the catch is if you don't stay for at least 2 years, they claw some of the bonus back. Okay. So I had to in order to leave Deloitte, I had to write a $2,500 check to Deloitte in order to leave. And it was probably the most nerve-wracking thing I had ever done at that point because here I am leaving the cushy corporate 9 to 5. Well, really, it was 9 to 9 nonstop. But here I was leaving the dream job in order to do what I do now. And don't let the fear of, don't let the fear, don't let that $2,500 get in the way of something so much greater. At least it was for me. So a lot of people have fear of the unknown, and a lot of people always ask like, well, what if it doesn't work out? But there's nobody in your life that's ever gonna tell you what if it could be better than you ever imagined. And that's what real estate investing and being an entrepreneur and a business owner was for me. So now we have, this should be corrected to say 12,000. I have a 12,000 person community on Facebook. It's Tax Strategies for Real Estate Investors with Ryan Bakey, a CPA. 73,000 followers. We have over 616 clients, and we have over 15 employees that are working full time to help you save as much money on taxes as possible. So real estate has also allowed me to invest in over 10 different real estate deals. So I do anything from multifamily, short-term rentals, RV parks, glamping. I get a lot of tax benefits that way. I spend a lot more time with my wife, and we're helping 500 plus real estate investors save 5 to 6 figures in taxes every single year. Okay, 3 biggest killers of wealth. When you're on the journey to build wealth, and you're on the roadmap to building wealth, there's going to be tolls, there's going to be stops for gas, there's going to be things that come up in the process that you didn't expect. And I've studied this a lot. I have an accounting and finance degree, and I've also studied, some of the richest people in the world. I've also studied some of the poorest people in the world. And the 3 biggest killers of wealth, I think, are taxes, inflation, and indecision. Okay, so taxes being, let's say you make 100 grand. Well, you're probably going to pay at least 20 to 25,000 in taxes. So now you're left with $80,000. Inflation is a killer of wealth because now that you kept that 80 grand and you left it in a bank account, well, inflation's going to eat away at that $80,000. So a year later, you're only left with $75,000 because of inflation. And it's not that money's getting sucked out of your bank account. It's because you lose purchasing power. Your money loses purchasing power the longer you leave it in a bank account. And then lastly, indecision. So here I am. I just made $100,000. 20,000 goes to taxes, and I haven't made a decision about where I'm going to invest the money, which that's also costing me money. Okay, we run into investors all the time who have maybe properties that aren't as profitable, or maybe they bought a property in the Smoky Mountains and it's gone up a lot in equity. Well, if that money should have been earning you a higher return, your indecision and your inability to not redeploy that cash into something else is costing you money because we see it every day. A client might have $400,000 of equity in a property, but it's only making them 10 grand a year in cash flow. So they would have to rent the property out for 40 years just to make back what they could walk away with if they sold it today. And then that 400K of equity could buy way more properties, way more equity, and more cash flow. So those are the three big killers of wealth, in my opinion. What expenses are the most missed? So we onboard, I don't know, 25 to 30 clients a month. And one of the things that we try to do is review their prior year tax returns to make sure that they weren't missing out on any deductions or expenses. The number one common denominator in anybody who's missing out on expenses or deductions, it's always my accountant never asked me. Okay. And one of the things that we pride ourselves on at our firm is the amount of questions and attention to detail and everything that we ask our clients to ensure that they're not missing any deductions at all. But like I said, the number one sort of common denominator, people just say, oh, yeah, my accountant never asked me about that, or they never asked me for that deduction. And so these are mostly the deductions that we see missed the most. So everybody's got to travel to and from your rentals, right? Whether you're driving to like a drivable market or you're flying to a vacation destination market, the travel to your rentals is going to be deductible. Any sort of data or internet, right? Like I run three different businesses from my cell phone. So 90% of my cell phone bill I write off. Of course, there's going to be some personal use because I got to go call my mom, dad, grandma, brother, sister, those people. But 90% of my phone bill, I write off because I'm running businesses. Any sort of legal or entity formation. So if you pay, attorneys to help you draft up your contracts or to help you close, like those are going to be deductible. Any sort of like entity formation fees when you go to set up LLCs are going to be deductible. Of course, any accounting or consulting fees are deductible, market research tools. And then one thing here at the bottom, or two things at the bottom I'd like to point out. So when you first start buying properties and you have a lot of renovations and repairs and furniture to add to your property, there's two things that you can do from an accounting perspective. You can either choose to capitalize that and depreciate it over time, or you can choose to write it off immediately if you qualify. There's pros and cons to both, and I could do an entire presentation just on this topic, but I just want you to understand that it depends on the season that you're in as an investor. If you're just starting off and you only have one property and you just bought your first property, second property, and you need as much income as possible in order to go to the bank and qualify for more loans, well, you're going to want to depreciate everything. Why? Because the lenders let you add back depreciation to your income in order to determine how much you can borrow on the next house. If you expense everything, the lenders don't add back expenses, repairs and maintenance expense, furniture expense. Lenders don't add back expenses. So you have to be really careful depending on what season you are as an investor and what you shows up on your tax return. So if you're somebody with, like I said, your first or second property, you don't want to expense everything under the sun because you're going to need that income from the properties, from your W-2 to help you qualify for more loans. If you're a more seasoned investor, like let's say you already have four or five properties, decent income, then you can expense everything because you're likely going to qualify for another loan. And that's why the number one mistake that investors make that prevents them from scaling is they don't know how to manage their debt to income ratio good enough. And so you really want to have a close relationship with your lender and your debt to income ratio to understand whether or not you can buy that next investment property, right? And then lastly, closing costs. So we see closing costs get missed all the time. Typically, closing costs are going to be about 3% of your purchase price. So if you bought a $500,000 home, you're going to have about 15K in closing costs. Well, some of those we don't even see show up on tax returns sometimes. for clients. And imagine paying 15 grand in fees and not being able to deduct those. Well, we see it all the time. If you're taking your tax return to an H&R Block or a TurboTax, I guarantee you're probably missing out on closing costs. So that's something to just always ask your accountant, like, hey, where can you show me on the tax return where exactly my closing costs are being deducted? Okay. Put your questions in the chat if you have them as they come up, and my team's gonna work to answer them. Okay. Let's see. So what's interesting is the best deduction for real estate investors is not something you actually come out of pocket for, but it's this thing called depreciation. So depreciation is the wear and tear on your building. The longer you own it, the less the building structure is actually worth. It's actually the land that goes up in value over time. It's not the actual building, right? That's why if you have a 1800s home versus a brand new 2000s home, generally the 2000 home is going to be worth more because it's made of newer materials. Now, obviously there's antique homes and things like that, but it's not the building that goes up over time, it's the land that goes up over time that the building sits upon. The building actually goes down in value. And the way that the IRS gives you essentially credit for that or deductions for that is they give you this thing called depreciation. So it's a tax-free it's tax-free cash because it's an expense that shows up on your tax return, but you don't actually have to come out of pocket for it. One of the things that talk all the time about is the tax benefits that you get from buying a rental property are always fixed. It doesn't matter if you put 5, 10, 20, 30%, or if you buy it all in cash. The tax benefits that you get on a rental property are the same. So just keep that in mind. Now, as of late, it's harder to put just 10% down on a property because you're going to be paying a lot in interest. But just know whether you put 10% down or 100% down, you're going to save the same amount of money on taxes. Okay. So by the numbers, so that Smoky Mountain cabin had a purchase price of 500K. Now, you can't depreciate land. Okay? Land is not depreciable. So you have to back out the value of the land. This becomes important for those of you that have super high incomes and you want to save a bunch of money on taxes. If you have a high income and you want to save money on taxes, don't go buy properties in a beach market that you own the land. You're not going to get a lot of tax benefits out of that. You want to buy properties in areas where the land isn't worth as much. Smoky Mountains is great. Midwest is great. What's cool is you can go on the county assessor website and figure all this information out. Just go and pull up the property's address and go and pull up the county tax cards, and it'll tell you what's the breakout between building and land, by the way. Anyway, so you're going to have gross revenue of that property typically comes in about 17% of the purchase price, 80K. You're going to have 60% of your revenue is going to go towards expenses, and you're going to be left with $32,000 net operating income on that property. So the depreciation that you get just by owning the home is $11,000. So even though $32,000 hits your bank account, the amount of money that you actually pay taxes on is only 20,462. So if I was down payment, closing costs, if I was 25% down into this property, that means I put $125,000 up. Well, this is a 26% cash on cash return. Okay. Now, with tax strategy, anytime that we have income or like we have a sale or we have a profit, we want to push that off as long as possible. The longer we can push off a sale as legal as possible, the less taxes we're going to pay, right? But if we have an expense, like if we have deductions, we want to be able to speed those up as quick as possible, right? And that's where what's called a cost segregation study comes in because we can speed up the rate at which we take depreciation. So in this example, I'll see if I can, here we go. I can make it bigger for everybody. So in this example, instead of only getting $11,000 of depreciation, this client, the taxpayer got $112,000 of depreciation. Okay. You could think of depreciation kind of like a piggy bank. So when you buy a rental property, you get this piggy bank of tax savings. So when I was younger, my parents bought me this like I don't know if it was ceramic or I think it was made out of clay, like a clay Winnie the Pooh piggy bank. and money could only go in it. It can never come out. So it had to be smashed in order to take money out. And my dad put 50 bucks in there every single year I had a birthday. And he's like, "Oh, when you're 18, you'll be able to pull money out of it." I still have not gotten any of that money, by the way. But I think about that a lot because that's essentially what depreciation is. When you buy a property, you're going to get these tax benefits, but over a long period of time. It's 39 years for short-term rentals, and it's 27 and a half years for long-term rentals. So you're getting those tax benefits, but you're only getting them spread out over 39 years. We want to speed it up, and we want it now. It's those commercials where the actor's like, "It's my money and I need it now." We When you have depreciation and expenses, you want it right now. And so a cost segregation allows you to speed up the rate at which you take that depreciation. Okay. So instead of getting only 11,000 of depreciation, we get 112,000 of depreciation, which means that instead of having to pay taxes on 20,000, my taxable income is now negative 80,500. Okay. And this is where it gets interesting because what happens to the loss? Well, our firm specializes in teaching investors how they can use that loss to offset their W-2 or their business income. So we work with you on teaching you strategies on how to use that loss to offset your income and make sure you're doing it by the book and you don't get audited and lose a bunch of money. So the year one cash on cash we said before was 26%. It goes all the way up to 48% because we just saved $28,000 in taxes. Well, how did we save $28,000 in taxes? We had an $80,000 loss and our tax rate was 35%. That's how we saved $28,000 in taxes, right? So I can add that $28,000 back to my net operating income for a year one cash on cash after tax savings. On average, uh, on average, this study is going to boost your year one cash on cash by about 20% in the first year by doing this strategy. Okay. Let's see. Might have to. So passive losses and how they work. Um, Everybody always hears the phrase that Warren Buffett pays less in taxes than his secretary does. And it's not the fact that he actually is paying less dollar for dollar. It's the fact that of all the income that he makes, the percentage of taxes that he pays is a lot less. And it's because all of his income is considered passive. Okay. So passive income can be a variety of things. It can be it can be short-term rentals, it can be long-term rentals, it can be laundromats, it can be businesses in which you own but you don't run the day-to-day operations of. All of these can be passive. And the cool thing about passive income is it can be offset by passive losses. So this is a snapshot of my 2022 tax return. I had a long-term rental that netted $10,000 a year in profit. I sold another long-term rental for a $70,000 profit. I had a laundromat that netted 20 grand a year in cash flow. So that was $100,000 in total profit. Profit from a sale of a building, profit from owning rentals and laundromats. And then that short-term rental that I showed you, I bought the short-term rental and I was able to generate over $100,000 loss from the short-term rental that I was able to use to offset the income from those other activities, right? I call it robbing Peter to pay Paul sometimes, but let's go through what I talked about earlier. What are the three biggest killers of wealth? Taxes, inflation, and indecision. So had I have just held on to this $100,000 in profit, I would have had to pay taxes, right? If I would have left it in a bank account, I would have lost value to inflation. Yep. And if I didn't do anything with the money, I would have missed out on the profit that the short-term rental made in cash flow, right? The 20, the $32,000 a year in cash flow that the short-term rental made. So I was able to, number one, save money on taxes. I was able to let inflation work for me instead of me paying back money to somebody else. And then I was taking advantage of not being indecisive. Not a lot of people in this world get super rich or wealthy without making really quick decisions. We want to be we don't want to be hasteful in the decision making, but we want to make like important decisions like this quicker than the average bear. Okay. We want to make good decisions about this because had I have just let that money sit in the bank account, it would have been taxed and I would have lost value because of inflation. Okay. So the short-term rental loophole is something that we talk about. So going back to this, how do you actually use this loss to offset your W-2 income? Okay. Well, you have to follow a couple of rules. Okay. So let's see where they at. So the average guest of your property has to stay 7 days or less. It even rhymes for you. Okay. So what you can do for this is just add up the total amount of days that the property was rented on Airbnb or Vrbo. Let's say it was rented out for 150 days. And then let's say I had 50 unique bookings, right? So if I do 150 divided by 50, that's an average of 3. So 3 is less than 7, so I check box number 1. And then box number 2 is, and I don't want to bore everybody with these tests, but basically you pretty much have to self-manage your property, okay? Um, if you don't self-manage your property, at least in that first year, you're not going to qualify to take the loss against your W-2. You remember, you can still take the losses against your other rental income or any sort of sale. But if you want to take the losses against your W-2 income, you have to meet these material participation tests. And I don't know if I listed them, but it's a fancy word for saying that you pretty much have to self-manage your property at least in that first year, okay? You don't have to be the one that cleans it, but you have to be the one that renovates it, fixes it up, gets it listed on Airbnb, does the description, communicates with the guests, things like that. Okay. This is an example of a client that did this strategy. So in 2022, they paid $89,000 in income taxes. And I can't exactly remember the total amount of build or property that they were looking at, but I think they ended up building an $800,000 to $900,000 property. Maybe it was closer to $1 million, but they went from paying $89,000 in federal income taxes to paying nothing in federal income taxes because they implemented the short-term rental loophole. Um, and it's just an amazing strategy for those that have owned properties for a couple of years now. You can always go. I know that was a question I think I just saw in the chat. Like you can always go back and do them. Like if this is your first time hearing about cost segregations and studies and things like this, like you can go back and do them, um, and catch up on the savings that you missed. But this is just an example. Like we've saved people so much money in taxes by implementing some of these strategies. And like I said, if you're an STR owner, this is probably the best thing since sliced bread. I mean, um, there's 8 wonders of the world. I think this is like the ninth one, or there's 7 wonders of the world. I can't remember. Okay. This is I want everybody to have access to this if you take away anything from the call. Um, but this is just a checklist to make sure that you have all of your documents in order to help prepare for your tax return. I'm gonna also drop the link in the chat. Uh, you might have to request access. Don't worry, I'll get access to everybody. I might have to um, approve it for you guys. Give me 1 second. I want to put the link in the chat too in case you didn't scan it quick enough. I'll just put that link in the chat. I'm working on the document right now. Let's see. So let's go through this just a second. Um, it just pretty much, remember I was saying earlier how most of the time people overpay on taxes because their accountant doesn't ask them for information. So when we ask our clients like, "Hey, why were you missing this?" or like, "I'm pretty sure you have property taxes. Why was that not being deducted?" Well, my accountant never asked. Okay. So let this be your sign and let this be the call to action that you need to never have that as an excuse ever again. So even if whether you're doing your taxes yourself, you're going to H&R Block, you're going to an accountant that's not us, I don't care. I just want to make sure that you're saving the most amount of money as possible. And if whoever's helping you with your tax return is not asking you about these documents and questions, I guarantee you're overpaying. Because this is just a snapshot. It's a list of all the possible deductions that you can have um, in order to save the most amount of money in taxes. Okay. So I'll just go through it just pretty quick. Talk about 1099s just for a second. So if you own and manage properties for other people, okay, let's say you own your own properties, but you also manage properties. Be really careful, and you want to inspect the 1099 that you get from Airbnb, especially because if I own properties on Airbnb and I also manage other people's properties on Airbnb, I'm gonna get a statement for all the properties combined together, all of the revenue, right? And the problem with that is that's being sent to my social security number or my EIN, right? And the IRS is expecting that I report all that income. Okay. So if that's you, you have to make sure that you're also 1099ing whoever you were receiving that money for. So if I was managing two of Taylor's properties, for example, I receive all that income. I need to send Taylor a 1099 for her share of those earnings. Okay. Otherwise, the IRS is going to expect me to pay taxes on all that. Okay. So check your 1099. What are they from Airbnb? Is it the MISC or the NEC? I think it's the miscellaneous from Airbnb. Um, check those because they're notoriously incorrect. They're incorrect a lot of times. Okay. Um, let's see. Yeah, you just have to request access and I'll make sure that you get it, but you'll have access to this. Um, let's go through short-term rentals, some stuff real quick that you'll need for your tax return. Appraisal. So everybody, unless you have a millions of dollars, you're probably buying properties with a loan. Therefore, if you're going to go to a bank that's going to give you a loan, you're going to need an appraisal. So we also want to see that. We want to see an appraisal because it'll let us know the value of the land sometimes of your property, and that way you can save more money in taxes. If you did a 1031 exchange, like let's say you 1031 into the short-term rental, or you 1031 out, we're going to need to see that paperwork too. The closing disclosure or settlement statement when you buy the property, that's how we're going to be able to take advantage of those closing costs. If you don't give us your closing disclosure or your settlement statement, then your accountant's not going to know what your closing fees were, right? And maybe they just assume it was nothing and they move on with their life. Property tax bill, profit and loss. So everybody should be keeping a profit and loss statement. I don't care if you only have one property or five properties. Like every rental property owner should be keeping a P&L of their business, of their rentals. If you're trying to play catch up, I would recommend downloading your bank statements into a CSV file or an Excel file, and then you can use a pivot table to kind of summarize and categorize a lot of the transactions. So that's if, like, let's say all of 2024 you didn't do any bookkeeping whatsoever, and you're trying to file your tax return in um, 60 days or less than 60 days, you download that Excel from your bank and put it in a pivot table, and that'll help you create your profit and loss that you'll need. If you formed LLCs, we're going to talk about entity structure in just a second. But if you formed LLCs, you're going to need that paperwork too in order to prepare your tax return. Okay. But yeah, you guys will have access to this cheat sheet, making sure that you don't miss out on any deductions. Give me 1 second. I'll get the screen back up. Okay. So some other strategies to save money. The one of my favorite strategies is what I call the live and flip. So because the tax code incentivizes people to homestead, and they don't really want a lot of volatility. Like a lot of money moving into the stock market or out is not good, and people moving in and out of homes all the time isn't good either. So they wanna incentivize you to stay in a primary residence for a long time and kind of settle down. And the reason and how they do that is if you own a property for at least 2 years and you use it as your primary residence, you most likely don't have to pay taxes when you go to sell it. There's been some cases where people pay taxes on their primary residence, California, whatever town in Georgia where the golf Masters tournaments played at, they'll see like capital gains on the sale of their primary residence, but most people are not going to have as much capital gains when they go to sell a property, their primary residence, because of this rule. Now, here's where we can get a little creative because oftentimes what happens is clients will come to us, they moved out of their primary, they bought a new home, and they're like, what do I do with it? Okay. So, in my opinion, here's where you need to run the analysis on how long or how long do you have to rent the property out for in order to break even? Because oftentimes than not, that property's got three or $400,000 of equity in it. But if you converted your old primary home to a rental, it may not do as well because of the location, the area. I mean, most people's primary homes don't make for good short-term rentals, right? Now, if you convert it to a rental, like let's say you decide to convert your old primary into a rental, remember it's 2 out of the 5 year rule. So you cannot rent it out longer than 3 years and still take advantage of these tax-free gains. So most people will rent the property out for up to 3 years after they move out of it and then sell it to be able to harvest those gains completely tax-free. If you rent it out one more day over those 3 years, the whole thing becomes taxable. Okay, so you got if that's going to be you, if you want to be renting out your old primary, got to be careful. If it has a lot of appreciation and a lot of gains, you want to sell it. Uh, in my opinion, you want to sell it before that 5 years total is up. It's always better to take tax-free money when you can versus tax deferred. Tax deferred would be something like we talk about 1031 exchanges in a second. 1031 exchanges are tax deferred. So it's not eliminating the tax bill, it's just deferring it to a future date, place, and time. With this section 121, the live and flip, it is a tax-free gain, which means you you run away with the money all free and clear, no taxes owed. Okay, so there's a huge difference between that and a deferral. So cash out refinance and HELOCs are both non-taxable events. So these are great ways to tap into some of the appreciation of your property in order to do whatever you want. Like maybe you're paying off other loans, or maybe you want to take money out of a property to buy another property, but you don't want to like get rid of the golden goose egg. Cash out refinances and HELOCs are non-taxable events. So if you bought the property in the Smoky Mountains for 300 grand and now it's worth 6 or 700,000 and you don't want to sell it, if there's decent enough cash flow on it, maybe consider getting a loan against it or a HELOC, so that way you can keep the golden goose egg and then use the money, redeploy it into another property. Okay. Um, the interest that you pay on refinances and HELOCs are subject to what are called interest tracing rules. So as long as you use that loan money for buying another property, for repairs and supplies for other properties, the interest that you pay on the HELOC is tax deductible too. Okay. Installment sales and seller financing. We don't see a lot of people that sell using seller financing just because when you it's your money and you want it now, obviously. But if a lot of you can learn how to utilize this and talk to sellers and get them to understand that their best way of selling the property is actually seller financing it to you. Um, I think the last 6 deals I've done have all been some type of seller financing involved. Whether the seller's carrying like a small note, whether they're seller financing the entire property or business, like I think the last 5 or 6 deals I've done have had some element of seller financing in them. And if this is something that's interesting to you, go check out some of my podcasts on this. It's just my first name, last name, The Ryan Bakey Show. But if you can convince a seller, hey, look, you don't want to sell that property and get all the money out of it because you're going to have a huge tax bill, right? Oh, by the way, what are you going to do with the money when you hold on to it? Because you're already 63, 65. You don't have time for the market to market. You don't have time for your money to be invested in the stock market because you need that money right away. A short-term investing in the stock market is not good because the stock market's volatile. You should seller finance me the property instead. and get a guaranteed, 5%, 6% interest rate, whatever it's going to be, 4% interest rate, right? So seller financing as a buyer, it benefits you a lot because you don't have to have tax returns, you don't have to have your credit score pulled, um, and you can convince the seller to finance you the property. That's one of the best ways to go, in my opinion. Um, on the sell side of seller financing, what it does is it defers the capital event. So let's say I sold I had an RV park for my entire life and it was worth $1 million when I sold it. Well, if I sell and I get an all cash deal, well, I'm gonna have to pay taxes on $1 million. Okay. Um, which means I'm gonna be left with 700 grand. And then remember, inflation is going to eat that away too. So now after a year, I'm really left with 650, 625, and so on, right? Um, but if I sell or finance it, I'm getting, instead of getting $1 million up front, I might be getting 130 grand a year for 10 years or whatever the deal is, but I'm also spreading out the amount of time that I have to pay taxes on. So instead of paying $300,000 in year one of taxes, I'm only going to have to pay, you know, 20 grand for 10 years. So I'm spreading out the amount of money that I'm paying up front, and I'm also spreading out the amount of money that I'm paying over time, which is two great tools to use there. So the 1031 like-kind exchange is another strategy to defer taxes. So you can think of this like in Monopoly when you trade four green houses for the Big Red Hotel. But remember, it's a deferral. It's not a free. Nowhere in here did I say free. At least I don't think. But the 1031 exchange is a tax deferred exchange. When you have a property with a lot of equity and you want to sell it for something else, you can 1031 your old property into it. And it doesn't have to be exactly alike. It can be a long-term rental into a short-term rental. It can be a short-term rental into a long-term rental. It can be, commercial into short-term rental. It just has to be used as a rental property, right? Um, what's cool about this is most of the time real estate investors want to lever up anyway. So when you do that analysis we were talking about earlier, like if you have a lot of equity in a property and it's only making you so much money, well, you're better off rolling that equity into a property that's going to make you more money, more cash flow. And you can do this with the 1031 exchange. Just keep in mind the timing of the exchange. So you have 45 days from when you sell property number one, the property that you own right now, to identify a replacement property. Okay, so if I sold my property on March 1st, I have until April 15th to identify a replacement property. It's not that long of time. It goes by really quick, the identification period. So before you even do a 1031 exchange, you want to have your options open and you kind of want to, know the area, know where you're going to want to buy because that 45 days happens really quick. So you have 45 days to identify the replacement property, and you have 180 days from the sale of the original property to close on that property. Okay. So you got a month and a half to identify, and then you got 6 total months to close in order to complete the 1031 exchange. And 27% of 1031 exchanges don't actually qualify and they don't actually make it. They don't identify the property in enough time. They don't work with their advisor close enough. So when you're gonna go to do a 1031, definitely don't cheap out on advisors and timing of it because the timing is one of the most important things when it comes to 1031 exchange. Okay. Income shifting is another strategy some people might want to think about. So income shifting is just where you hire your kids or other family members, maybe like a mom or dad, to help work in your properties. So like my dad's retired, and he just retired last year. So him and my mom don't make a lot of money combined anymore. So I shift my income to him because he's my property manager. So he manages all the long-term rentals that I have in my state, and I get to shift income from my 37% tax bracket down to his 12% bracket, right? So I like to think of that as a good favor. He has to pick it up as income. I get to write it off, but I get to help him out. But where this is normally done is with your kids. So if you have kids that can, let's say, file paperwork, help cut the grass, communicate with guests, maybe they work on your websites or your design of your properties. Maybe they help you assemble furniture. Maybe they help you pick out furniture. Um, one of the things that we, one of the things I heard from somebody that they do is they actually, whenever they're done designing a property or before they're done designing a property, they take their kids and just put them in the property and see exactly where they go to right away, or exactly where they run to. So like one of my friends had a Disney themed property, and the boys just immediately ran to the Toy Story room, or yeah, the Buzz Lightyear room, right? And then the girls immediately ran to the like a princess room, or at the time the Frozen movie was like huge, so they had a Frozen themed. But if you're going to be catering to like the small, younger families, think about your kids and how your kids enjoy that space, because it's likely that somebody else's kids would also enjoy that space, and try to do it in a tax efficient way. So you're making high W-2, high business income, you're paying a super high tax rate. Your kids, if they don't make any money, they virtually have zero tax rate. In fact, they can make what is it? It's up to $15,000 a year now that they can make federally, or IRS rules, before they have to pay taxes on that, right? And the best part about it is now that your child has earned income, they can contribute to a Roth. A Roth IRA is the most powerful financial vehicle that we have on planet Earth, in my opinion, because it earns and grows tax-free forever. You can access the money that you put in whenever you want. You can use that money for education, medical, first-time home. And the magic number there is 20,000 at age 20. If you can get $20,000 in your kid's Roth IRA at age 20, they become a millionaire by time they turn 60 with no additional contributions. Literally just lock that password away, throw away the key. Um, there's an old rap song. It's Jeezy and Jay-Z, and or no, it's Pusha T, and he's like, you got to lock away the first 500,000. Like, and I just think about that all the time. But like you get that 20 grand in your kid's Roth IRA and just lock it away. Just don't even give them the password forever. And you just made them a millionaire. Well, the IRS really just made them a millionaire, actually. Okay. See. So entity structuring, I mentioned that we were going to cover a little bit about this, and hopefully we have enough time. But one of the common mistakes that we see, I would say the most common mistake, is when spouses are involved in real estate together, they just assume that they should both be on an LLC. Well, if you have a multi-member LLC, that means that you have to file a multi-member tax return. Okay. If you just had a single member LLC, or you own the property in your personal name, then you don't have to file an additional tax return for it. So be really careful when you're first starting off to don't just go gung ho and put both spouses on LLCs all the time, because it creates these tax filing consequences that you have. Okay. Rental real estate should be held in a single member LLC or a multi-member LLC taxed as a partnership. So if Taylor and I own a property together, let's say, or Mason and I own a property together, it's probably going to be in a multi-member LLC, and we're going to have to file a tax return for that. Now, if you own properties with non-spouses, okay, you can't get out of filing the partnership return. It's just a way of life. It's just how it's going to be. I have to file like 7 or 8 returns because I own a bunch of properties with people that aren't my spouse. But the properties that you own between you and your spouse, or like that you own by yourself, you want to have those in a holding company structure that only requires you to file one tax return, and that's your personal return. Okay. And I'm going to show you guys examples of these structures in just a second. Now, you never, ever, ever want to own rentals in corporations. So like a S corporation or a C corporation, you don't want to own rentals in those, okay? But if you're one of these active businesses, like if you're a wholesaler, a flipper, an agent, a broker, a property manager, a co-host, a CPA, an attorney, somebody who walks dogs for a living, you might want to have an S corporation because it'll help you save money on what's called self-employment taxes. Okay. So, but if we're going to own straight up rentals, whether it's long-term rentals or short-term rentals, we want to have those in either our personal names with really damn good insurance, a single member LLC, or a multi-member LLC taxed as a partnership. Okay. Let's see. I have a structure somewhere that I was going to share. Okay. So this is an example of like a base layer structure. Um, so let's say you only own properties with you or you and your spouse. Okay. So here's the property that you're going to own, and here's you up here. You're the client. And notice all the additional layers of protection. Now, some of these things, like the revocable living trust, those take some time. We normally don't advise clients to have those until they hit, I would say, $3 million net worth or so, maybe two. The more kids that you have, the more likely you are going to have a revocable living trust at the top. If you don't got as much kids, not going to need a revocable living trust. Okay. But where a lot of people make the mistake of is they go and set up an LLC in the state where the property's at, which, by the way, the LLC that owns the property should always be in the state where the property is located at. So if I own a Florida property, I should have a Florida LLC that owns the Florida property. You got me? And now I live in Illinois, but I own a Florida property. I have a Florida LLC that owns the Florida property. Okay. I don't have an Illinois LLC that owns the Florida property. Why? Well, if I get sued and I have to go to court and the judge sees that I'm an Illinois LLC, they're going to look at me like I have two heads because I'm not in business in Florida. I live in Illinois. So whatever state that your property is located in, that's also the state where you want to have your LLC that owns the property. Now notice how I have a holding company above this. This is typically going to be in a Wyoming, Delaware, Nevada, Ohio sometimes, mostly Wyoming though. And that's for another layer of anonymity protection. So the problem with owning a property directly in an LLC is most of the time you can go on that LLC that state's Secretary of State website and see who owns the property. So if I just own the property through an LLC, they can figure out the LLC's name, then they can go on the Secretary of State and see who owns the LLC. Well, if I have the Wyoming holding company, Wyoming doesn't report to the Secretary of State or anybody. It doesn't report the member's interest. So if you slipped and falled in this property, you can see that my LLC owns it. You can go on the Secretary of State website and see uh, who owns it. It's the Wyoming LLC. But when you go on Wyoming's website, they don't disclose any interest. So the buck kind of stops there. And the whole thing behind asset protection is you're trying to make it as hard as possible for people to come after you because most lawyers in personal injury are going to work off of contingency or commission. So they really don't get paid unless they win a case. And if they see that you have a pretty good that you have a good asset protection structure, they're most likely going to want to settle with your insurance company here at the bottom. Okay. Now, I'm not a lawyer. I'm not your lawyer. I don't even pretend to be a lawyer. I'm just saying this is a typical structure that we see with most of our real estate clients. Okay. Um, when you start owning properties with other people, well, then you have to come into what's called a partnership entity structure. So you might have two other investors that go in with you. Well, those investors are going to be part of the holding company, right? Same thing with you. You're going to be part of the holding company. And then that holding company is going to own the properties, right? All the investors don't own the property as their personal name. Never. It's always the investors form a holding company, typically using their LLCs, and then it's that holding company that's going to own the properties. And remember that the LLC, let's say this holding company has a property in Florida and a property in Illinois. Well, this is going to be a Florida LLC. This is going to be an Illinois LLC, but they're going to be owned by a Wyoming holding company. Does that make sense? Okay. Whose brain is fried? Okay. Put your questions in the chat. We're going to try to get to all of them. Um, I would say, let's see where we can leave this off, and maybe have time for, I guess, live questions, but let's see. I have one more slide, one or two more slides. I know it was a lot. Um, okay, question. Pop quiz time. Who who has seen this movie before?
Take the old car when it's sweat out. Take the new car.
Um, you got her? Okay.
Yeah, with Leonardo DiCaprio.
So this is one of my favorite movies, Catch Me If You Can. It's Leonardo DiCaprio. It's one of his like earlier movies, like when he was really young. But the movie is supposed to be based on a true story, and it's about the guy Frank Abagnale who fakes being a doctor, a lawyer, a pilot, a nurse, basically everything, right? And in the movie, Leonardo DiCaprio plays the I guess villain in the movie, right? But Tom Hanks plays the FBI agent, and like the entire movie is Tom Hanks trying to track down Leonardo DiCaprio in the movie. And when he finally gets him, he finally catches him. He goes, out of all the stuff that you've done, um, out of all the stuff that you've faked being a doctor, a pilot, a lawyer, all this, he goes, how did you teach an entire semester in psychology at BYU without ever studying it in school? Like, how did you teach an entire semester? And in the movie, he responds, and there's also something about the bar exam too. But in the movie, he responds like, well, I didn't need to know the entire semester. I just had to be one chapter ahead of the students. Okay. So he's like, I read the chapter the night before, and then I taught the students the next day. And I took from that is that whenever you're trying to level up in life, you need to find a mentor, and you need to find a coach. You need to find experts. You need to find people that, care for you. Like Minoan's great with that, right? They can meet you exactly where you're at. So you when you're looking to find a mentor, you just want to find somebody that's one step ahead of you. Okay. And so we like to pride ourselves in just being one step ahead of our investors. So we really try to make it our purpose and our point to meet you where you're at. If your level base and your knowledge is here, we're going to meet you just one step ahead, one chapter ahead of where you're at. And that's a good sign of like any
Yeah.
mentor, any coach, anybody that's going to inspire you, they should just be one chapter ahead. So I hope that's helpful. If you want to book time with our team to have our team prepare your tax returns this year, you can go to retaxprep.com, or you can scan that QR code and fill in your information there. And we're happy to schedule a call with you to help you prepare your tax returns this year. Okay?
Thank you so much, Ryan. Yeah, we'll also send out this link in our follow-up email as well as an entire recording of this webinar so that you can rewatch parts that you missed or want to learn more about. Thank you so much, Ryan, for all this information. It was so helpful. And like I said, we will be reaching out via email with a follow-up, and you can, of course, reply to that with any other questions. So yeah, everyone have a great afternoon. Thank you so much. And we are always here if you guys need anything.
I think we got to all of them, right?
I think we did. It looks like the chat was, you guys were on top of it, which I really appreciate that. It's awesome. Quick.
Okay. Well, awesome. Thank you, everyone.
Thank
All
you,
right.
Ryan.
Guys, have a great afternoon.
All right, everyone. Bye for now.
Bye.